My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job is not just to entertain you, but to educate, teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Memo to the Fed. Be careful what you wish for, because you may already be getting it. Today we got the minutes of the Fed meeting from April 30th to May 1st. I know these are now rearview mirror pros, but Wall Street obsesses on anything the Fed does. And when the minutes reflected a harsh review on inflation, the market got clubbed. With Dow tumbling 202 points, S&P sinking 0.27%, Nasdaq climbed 0.18%. Now, we've been doing fine today until these remarks were released. And then we had the sudden drop, even as the minutes reflect negative data long since forgotten. Now, what the heck did the Fed say 3 weeks ago that could scare the market so badly? Look, these Fed officials were lamenting that inflation hasn't come down fast enough and might even be ticking up. Ever since the Fed pivoted last fall into a stance of no more rate hikes, which then caused the stock market to go up. Well, the Fed's been waiting for inflation to roll over. Today's minutes indicated they've become impatient with the pace of decline. They were hoping it would go down faster. Hey, so is everyone else. But in the 3 weeks since the Fed meeting occurred, guess what? The minutes that the meeting reflected, everything's going the Fed's way. Just consider these inflation wins post-meeting. We got a labor report that indicated the economy was cooling, wages had stabilized, usually important report. And if the Fed had seen these numbers ahead of time, I bet there would have been a lot less hand-wringing. The minutes might have actually been positive. After that, we got a cooler than expected consumer price index reading. Then we had a dramatically weaker retail sales number, much lower than expected. Again, I think the Fed officials would have sung a different, more positive tune if they had seen these numbers ahead. At the time of the last Fed meeting, we were dealing with nascent commodity inflation. Oil had spiked. Copper had broken out. Now oil, aided by a surprise draining of the Strategic Petroleum Reserve, it looks like it's breaking down. Copper, which had been on a furious tear, some say a short squeeze, got pancaked today. That matters because copper doesn't spike unless the global economy is really heating up. Copper's used in housing, especially in China, and electric vehicles and data centers. Traders use Freeport-McMoRan FCX as our largest copper producer, proxy for it. It's been straight up until today, when the stock was down more than 5%. I'm not concerned about copper. It's abundant. All you got to do is dig a little more. Yeah, oil and copper going the Fed's way. So, how about the consumer? 2/3 of our economy is based on the consumer. The consumer's been so robust, I'm sure there are some incredibly frustrated people at the Fed. And you can hear them saying, what will it take to get this consumer to stop spending? Is there any price that's too high for them? Or have they become so accepting of inflation they just don't care and won't rebel? And that is the problem that we've seen with countries that have embedded inflation. When these officials looked at the consumer 3 weeks ago, they probably felt like the Fed should never have stopped tightening. Because without a pullback in consumer spending, we can't beat inflation, particularly when we have such good job growth. I know the various Fed governors and regional Fed presidents love to give speeches and interviews. They love the limelight. They certainly aren't shy. Some of them may be gas bags. They all seem like failed actors and actresses. But if they'd taken a moment from speaking and actually look at the companies that are leading indicators, they'd recognize that they're finally winning the war with the consumer spend, too. No victory lap. But we're getting nascent signs that enough is enough. There's some buyer strikes. Let's take Walmart, which put a great quarter, in part thanks to its booming grocery business. Remember, they're the largest grocer in America, and their sales are extraordinarily strong, maybe too strong. What's driving that? When you dig, when you come up with that, after years of seemingly endless price increases, the consumer has had enough. The consumer is now staying more at home. Unless you can offer me some sort of deal, an $11 steal like at Texas Roadhouse or Brinker's Chili's, I'm just going to go to Walmart, throw in a couple of steaks on the Traeger or maybe the Weber, especially now it's nice out. People want value now. Walmart's one of the few that are offering it. It's happening right now. Hey, TJX was doing really terrific. You don't do really terrific at TJX unless you're saying, I'm not going to Macy's. Although I like that Macy's quarter. What else? Apparently, the franchisees of McDonald's are grousing at the company's forcing a $5 value meal down their throats. I'm sure there's some areas where there's no resistance to higher prices, but those are exceptions. When you look at McDonald's as a whole, it's clear people have had enough of their raising price, too. They need that $5 value meal to boost traffic. I wonder if the Fed's heads have spotted the cheaper burger and cheered it. It's part of the overall buyer strike. They had to swing by McDonald's. Could be good for them. We'll hear directly from the source, the biggest restaurant supplier in the country tonight, Cisco. And I think they're going to tell a story of newfound resistance to higher prices. And now, how do I say that? Because listen to what CEO Kevin Hurricane at this analyst day said, and I'm quoting, "It is our belief that restaurant menu prices have impacted foot traffic, and this is something that needs to be addressed more broadly by the industry," end quote. He goes on, quote, "The industry needs to take action to improve affordability for end consumers," end quote. Hey, come on. That's the budding consumer rebellion. Now, we're not seeing a buyer strike just yet everywhere. Last night, Toll Brothers reported a very good quarter, sold a ton of homes at $1 million a pop, getting that price down for a while. Toll's earnings are so juicy, the company finally increased its building of new homes. Stock popped on the news. But then today, the skeptics jump in, immediately wonder, wait a second, maybe Toll's going to build too many homes. Maybe there's going to be some supply at last. They question whether there's at last some resistance to price at the $1 million mark because it's been there for a couple of weeks. They think the housing cycle may be over, so they want to get out of the best home builder before the cracks occur, so the stock goes down 11 points or 8.5%. Oh, and there's also the anecdotal. Target sells goods that are pricier than Walmart. Target delivers inline earnings. Walmart gave us much better than expected numbers. Is that the consumer beginning to rebel? Target stock goes down 12 or 8%. Lulu stock's been going down for ages, but could that be the consumer opting for cheaper athleisure? Could be. Lulu stock plummets $23 or 7.2%. Fed, listen up. There are suddenly buyer strikes all over the place. Now, all of this actual macro activity is vying for headlines with NVIDIA. And when the third largest company on earth reported it delivered another great quarter, a big top and bottom line beat with management issuing a better than expected outlook for the current quarter, well, the stock jumped in after hours trading, even better for individual investors, not necessarily the institutions. They announced a 10-for-1 stock split and boosted the dividend from 4 cents to 10 cents per quarter, which will actually be 1 cent per share post-split. The stock got a boost in after hours trading, but not by an insane amount, because NVIDIA, well, let's just say it's in the habit of blowing away the numbers. Oh, and DuPont, let's not forget that. Chemical, healthcare, electronics, and water company decided tonight it's going to split into 3 companies. It's a huge win for Ed Breen, the now outgoing CEO, and for shareholders like my charitable trust. Tomorrow, it will matter regardless of those meeting notes, and I will certainly fill everybody in this evening who are members of the club about what it means. Bottom line, for the part of the market that isn't tech or industrials like DuPont, for the part of the market that was consumer-oriented, today was a day when the Fed won. Let's hope the Fed conclave realizes that their inflation lamentation from 3 weeks ago may no longer be necessary. If they don't, and they stay upset about the prospects for deflation just when it's finally happening, then we might have quite a few more days like this one. Why don't we start with Josh in Alabama? Josh.
Hey, Jim. How are you?
I'm good, Josh. How are you doing?
I'm good. Thank you for taking my call.
Of course.
First time, long time, and a club member. And I say that because I want to thank you and your team for all the hard work that you put in every day to teach us and steer us towards financial freedom.
Thank you. And Jeff Marks and Zeph Vima right now working on DuPont, working on NVIDIA, trying to bring it to you because that's what matters. How can I help?
Jim, my question is about Disney. I've had a long position in Disney for several years now, and over the past couple of years, I've continued to add to the position as the stock has slid down and to the right. Despite Bob Iger's return, the company has still had an underperformance in the market. And understanding how tight the streaming market is, do you think that the other revenue streams, including parks, are enough to stay in the stock?
All right. Well, we got to blow out a lot of Disney for the club when it was higher. Thank you, Nelson Peltz, for doing that, although I think he doesn't get enough credit for actually moving the stock higher. It's now all the way back down where we are inclined at $100 to buy more. So if we're inclined to buy it and you're a club member, then you know this is a very good level. The stock has gotten too cheap. Let's go to John in Washington. John.
Booyah, Jimmy Chill. This is John from beautiful Seattle, Washington.
I am feeling chill.
I want to know what your thoughts are on Rivian, baby.
Rivian. Okay, my wife wants to buy one. She looked at the stock price. She says, hey, are they going to be in business? Don't worry about Rivian. They have a lot of money coming out their way. But I'm glad she didn't say she wanted to lose it. Let's put it like that. All right, how about Jackson in North Carolina? Jack.
Hey, how's it going?
It's good. It's good. How about you?
Doing pretty good. Pretty good.
Good. I want to be sure.
Sounds good.
No problem.
All right. So what do you think about the future of ARM Holdings? Not the last earnings report wasn't the best, but
no, you're right. But you know what? Let's give. First of all, the stock is up since Renee gave you that quarter. Second, I'll say this about Renee, man. That he gave you a good price for that underwriting. It is going, gave all the way up, went all the way up, and then gave back some. But they are here to stay, and that is maybe one of the highest growth companies. I think it's a lot better than Qualcomm. Everybody's all crazy about Qualcomm. I'm bagging with Renee. I think he's real good. All right, listen to me. For the part of the market that is consumer-oriented, today was a day where the Fed won, and that's 2/3 of the economy. Let's just hope they realize that their regrets over inflation from nearly a month ago may not be necessary at this point in the cycle. On Mad Money tonight, Williams-Sonoma reported a strong quarter before the bell, and the stock shot up to an all-time high. But throughout the session, there was buyer's remorse. Stock finished lower. I'm sitting down with the CEO, get a better read. Then Cisco, we just mentioned, the SYY kind, reported a disappointing quarter last month. So I'm checking out what's happening at that company, giant restaurant supplier. Are they seeing less foot traffic? And later, Snowflake CEO is going to be fresh off the company's call, real fresh, to break down what we should make of his tech quarter. Remember, tech's doing well. Go NVIDIA. It's David Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
All right, what in the world just happened to the stock of Williams-Sonoma? This morning, the home goods and furniture retailer that you may know as Pottery Barn, West Elm, reported what I thought was a remarkably strong quarter. Delivered a huge 74-cent earnings beat off to $2.74 basis, higher than expected sales, same-store sales, terrific. They even raised their full-year operating margin guidance, which I love because this is a tough business. Initially, the stock opened up nearly 10%, hitting a new all-time high shortly after the open. Then it got hit with a wave of profit-taking. It only finished the day down 11%. There was also an accounting issue that, to me, was, frankly, very meaningless. But you know how people are with those things. How did Williams-Sonoma pull off such a strong quarter, and why the heck did the stock sell off anyway? Is it just that people were looking for a chance to ring the register, given how much the stock has run? Or do we need to be more cautious? Let's check in with Laura Alber, the president and CEO of Williams-Sonoma, to get a better sense of the quarter and what's happened. Ms. Alber, welcome back to Mad Money. How are you?
I'm good. How are you?
Okay. Well, no, I'm not good because you see, Laura, when I left to go to the dentist, the stock was up 30. And when I got out and woke up, it was down 30. And I still think it's the same company the whole time. Would you agree with me that it's the same company?
You can't worry about a day in the stock market. But, we're focused on what we can control, and that's served us well over the long term. And right now, we're proving that we can perform in any environment, and we can continue to increase profits higher than people expected. And this is a quarter that showed us that. We beat earnings, we beat the top line guidance, we took up the year, but it's early in the year, so we probably didn't take it up as much as they wanted. But it's early in the year, and we got to give ourselves some flexibility.
Well, I think that's right. I think you understand. Unfortunately, it is a bit of a game. We don't like to play it on Mad Money because we've liked your stock the whole way, because we think that you do a great job, and because we think that your stuff has a look, it has a feel, it has a sense of quality that is not having it caught up with things that people are saying, well, wait a second, there's a buyer strike. I'm not paying those prices. They are paying your prices.
Yeah, we have a very different competitive advantage than most, which is that we design our own products. And we have our own sourcing organization, so we're able to bring innovative products that no one else sells, frankly, in the market, and bring them at better prices and better quality than our competition.
At the same time, you did say in one sentence that promotional activity is extremely aggressive, but then you also said it's always aggressive. So, I have to believe that the halcyon days where you could charge whatever you want ended a long time ago. You're still in a competitive business, even though you do have that competitive edge.
Look, we're studying everybody's prices all the time, and where we win is when we bring in product that's the best quality value relationship in the market. And our customers seeing things from us that they haven't seen before, and they're really responding. We also know that, the customer isn't shopping for as much furniture as they were because of the housing slump, but they are, still updating their homes. They love their homes. It's their biggest asset. And so we've leaned into what we call easy updates. Things that you do to your house even when you're not moving. And it's really important for people to realize, as much as there is this, housing slump, if you will, that we're not just a furniture brand. We have seasonal holidays, we have collaborations, we celebrate life stage events. And that's what's given us a lot of resilience, even in what's a more difficult market.
Well, you broke one of the taboos. You said that this isn't historically an important quarter. There's no holidays. I mean, there is no seasonal. I saw your Halloween stuff. I mean, it's got to be good for a couple of points. It was that good. Each of the holidays have it, except for this one particular time. Now, you do have 3 weeks of the next quarter in the quarter, and I think you said, listen, let's not play my hand on that. But I think it's been pretty consistently better, is the way I want to look at it, regardless of the seasons. It's a consistency thing. And what I keep hoping is that the brands that you throw out at the end, like the Rejuvenation and et al., the 4 brands, that one day you'll say, you know what? These are brands that you need to focus on, Jim. These are really starting to become a major part of the mix. Anytime soon?
Well, every brand that we now have started off as a very small business. I started in 1995, and the whole company was just a fraction of what it was, and half the brands weren't even there. More than half, 75%. We've built these brands. We have people who are passionate about what they're doing, who are entrepreneurs. And that's a really important part of our culture, is keeping that entrepreneurial spirit amidst a company that's a big operator and that everybody depends on for execution. And so we do both, and I think that's what keeps us really hungry for the win.
No, I think those work for why you're getting B2B. I think the B2B tends to be a CEO who says, you know what, I really like this stuff. Let's just have it in our places. At the same time, I can't tell when you get a 10% business growth what it really means for the bottom line, because you don't break out that group with Dave & Buster's, Jamestown Properties, Marriott. Is that because it's just not significant yet and one day you'll break it out, or is it because it should just be part of the business in general?
Well, it is part of each brand. So if you're buying, from West Elm, it's in the brand. But at the same time, we look at it separately to hold people accountable who are pushing those lines of business. And, we have the trade business and we have the contract business. They're very different motions. The trade business is more like the consumer business, and the contract business is more of an annuity where you get a big deal and then they have to replace it. They have more units. And so it is slightly different that way. But right now it's not big enough, no.
Okay, so 2 things that that I guess got some bee in a bonnet. One was Pottery Barn not strong enough and it's big. And then the other is this freight issue. The freight issue to me was just something, it was the way you had to report it was exactly the way the accounting laws say you have to report it. It was not meaningful, but it did distort a headline. Is that fair?
Well, we were very clear in our headlines, and it was not material to any previous period and not material for this year. It was that we overaccrued freight. So we had a $49 true up that we caught, and the minute we caught it, we were transparent and mentioned it.
Right. Oh, no. Look, please don't be defensive. I'm just saying that I'm trying to figure out why the knucklehead sold it, okay? That's my job. You don't have to do that. You can keep selling all the furniture. I got to figure out what happened to the stock, because I have a more pedestrian job. But I do think there might have been some people who say, listen, if Pottery Barn doesn't, maybe Pottery Barn's part of what's caught up in the fatigue of buyers, so to speak. And I just need to know that Pottery Barn's just business as usual. It's going to, when it clicks, it clicks.
There's a couple things to know about Pottery Barn that maybe we weren't clear enough about. First of all, Pottery Barn is a beautiful brand. Customers love Pottery Barn. And we have great innovation that's working in that business. The difference is that last year we had a lot more promotions, and we have made a big decision that we're not going to continue to run that level of promotions. Hence, the margin is higher. And we are still really giving the customer great value, but we're not playing this competitive game against ourselves where the price goes up, the price goes down. You can count on us for the price until the item is discontinued or is on clearance now. That's a big difference in the way we're running the business. And I'd say the second thing is, of course, Pottery Barn is affected by the housing slump. It does have furniture in it, and that's industry wide. We're doing better than the industry, but of course that's going to affect us. And last year it was less affected. So when you look at it on a multi-year basis, really healthy business.
All right. I think you put it so that everybody understands it and understands that it was an excellent quarter, not just within the confines of the housing weakness, but just an excellent quarter, period. I want to thank Laura Albert, CEO of Williams-Sonoma. Laura, thank you for coming on the show. Great quarter.
Thank you.
Okay, Mad Money's back after the break.
Coming up, stock your pantry with this stock. Chow down on earnings when we return.
This earnings season, we've seen a new dynamic in the restaurant industry. Really, everybody's leaning on higher pricing to make up for some lagging traffic. There are some notable exceptions that have done much better by giving people value. But for the most part, I guess you could say that fewer people are dining out. Now, that could be weak news for the food service companies that supply the industry. Traffic is what they're levered to. Take Sysco, the largest global distributor of food and related products to the whole food away from home industry. I should say the much largest because they're so big. Today, they held an investor day here at New York Stock Exchange. In addition to talking about the future drivers of the business, management laid out their growth targets for the next 3 years. Now, maybe Wall Street didn't seem to like all these things because the stock got hit. But if you believe the restaurant industry is willing to cut prices in order to lure in more customers, or if it's just more robust than people realize, it could be a buying opportunity. But I think we need to do the homework, so let's dig deeper with Kevin Hurricane. He's the chair and CEO of Sysco Corporation. Good morning, Mr. Hurricane. Welcome back to Mad Money.
Jim, it's great to be here today with you.
Okay, so the takeaway of your investor day is basically that you've got a recipe for growth, and it's working.
Yep. Today we issued guidance to our investors for the next 3 years, which
most people can't do.
Yep, which was anchored around sales, profit, and total shareholder return. So we guided sales growth 4 to 6%. Earnings per share growth of 6 to 8%, and a total shareholder return, given our strong dividend and stock buybacks of 9 to 11%.
All right, so I read the headlines, and the headlines are really a function of where the stock trades the next minute. Mm-hmm. And they were saying, well, you know what, this is not what we wanted. We wanted much stronger. Given the vicissitudes of the world and what people's habits might be, would there be any reason why you would take it even higher?
Well, we're focused on delivering against the guidance that we put out today.
Right.
We believe the guidance we put forward is achievable guidance and that we can deliver against it consistently over time.
Now, you did allude to, you made, actually it was a striking comment that I quoted earlier in the show, which is that you said that there are moments right now where you think that the prices have gotten too high, and that's going to impact people. That there's a bit of a fatigue. Is that for everybody? Who's doing it too high? Because we know good operators like a Texas Roadhouse, a Brinker, that they're doing everything the right price point. If you have the right price point, it still works.
If you have a value prop that your customer connects with, you're succeeding in this market. But just in general, we serve over 700,000 customers worldwide. Right. Feedback from our end consumers, meaning you and I going to restaurants, is that menu prices are high right now. What we're doing is what we can control at Sysco to help in that equation. If we can bring down our purchase cost of food, right, we can pass on value to our customers, and we have multiple other ways to pass on value to our customers.
And you have multiple ways to keep down the price of what you pay.
Yes. Negotiating more strategically with our suppliers, partnering for a long term with our suppliers to create value for customers. In Sysco brand, Jim, we have a powerhouse brand of our private label product. When we can convert an item for our customer to Sysco brand, we save them money, and it is good for Sysco as well.
I don't want to leave out international. I mean, you're number 2 share position and some number 3 position in a bunch of countries in Europe. Now, Europe seems to be strong, too, all of a sudden.
Europe, from an overall economy perspective, isn't robust, but our specific business in Europe is strong. We actually grew our top and bottom line in our European business faster than the U.S. Mostly, Jim, though, that's more self-help, as some would describe it.
Fair enough.
We have an opportunity to really grow our business. We call it running the Sysco play overseas, bringing our broader assortment, modern technology for our supply chain, easier to do business with tools from a digital ordering perspective, specialty business, which I'd love to talk to you about, bringing that capability to Europe. And when we put all of those things together, we're winning in a meaningful way overseas.
Well, let's do that, because especially it's got a higher multiple, you give a higher multiple and a higher profit margin. It also, by the way, is cheaper for the restaurant because it's already done. You don't have a prep. Your prep kitchen guy who costs $22 an hour is not needed for these particular items.
Exactly. We're super pleased with our business results in our specialty business. We've grown it from $3.8 billion to almost $10 billion over the last 4 years. And we view another $10 billion of growth opportunity on top of that. And it's due to market share. Our market share overall, as you know, is 17%. Our market share in specialty is less than 10%. So we believe we have an opportunity to get our specialty market share up to our total broadline and win with those customers. What do we mean when we say specialty? Specialty produce, custom cut proteins. We have a Greco-Italian business, and recently an acquisition in the equipment and supplies called Edward Don, a 100-year-old company that we recently acquired.
Okay, now I always like my restaurants. I love the specialty business, but I did not like the price. I always felt that we could make very little money on specialty. Are these prices coming in under all the ones that you and I both know that traditionally do specialty?
Our specialty capabilities are providing value to the customer for bespoke, custom cut products or unique products, and we give our customer choice. If they want the best possible price delivered 1 or 2 days a week, we'll deliver that on a Sysco truck. If they want delivery 6 days a week for unique products with a late in the evening order cutoff and a specialty rep who is an expert in that product, there's a higher margin associated with those products. And it's actually why financially we're excited about it. It's a big growth opportunity and at a higher margin profile.
Okay, there's an outfit that I like. They have good point of service sales, Toast. And for the last couple of months, the analysts have been saying, you know what, the restaurant formations have slowed down. That April, not as many. March, not as many. So far, May, not as many. Are you seeing fewer new restaurants, fewer new customers?
Right. There's a lot of churn in this industry, as you know, doors open, doors close in aggregate. What we're seeing is less foot traffic to customers. We have an opportunity, though, to grow our business profitably by serving more of the customers that are out there. So even in a flat to down environment, Cisco can grow. We can grow profitably by serving more of the doors.
Okay, so the truck comes every day. What else could you put on the truck if you wanted to?
Well, that's where the specialty opportunity comes.
But no, I mean, beyond food, would you ever consider that?
I don't think we're going to, at this time, talk about non-food.
Okay.
We have such a growth opportunity with all things a kitchen needs, which that does include equipment and supplies. We just did a $1 billion top line acquisition with Edward Don, but it's about the things that our restaurant needs to be successful. So even in our broadline business, which is in the 30+% share range, Jim, we have such an opportunity to serve more doors, penetrate more with existing customers, and to grow the business.
Well, that's why I think that you're getting the stock a little cheaper than you should, because I think that you're naturally, correctly conservative. Well, who wants aggressive at the beginning of the year? Why be aggressive? Doesn't make any sense to me.
We want to put out guidance that we know we can beat consistently, deliver against consistently with an opportunity to beat over time.
And that's what we want. That's Kevin Hurricane. He's the chair and CEO of Cisco Corporate Company I've used. They are the top quality, and they're also the biggest. Mad Money's back after the break.
Coming up, a blizzard of earnings. Cramer sits down with Snowflake after the break.
Is Snowflake back on track after a couple of months in the wilderness? The last time we heard from this enterprise software and data analytics company was back in February. They reported a strong quarter with a tepid full-year forecast. Stock plunged from 230 down to the mid-100s. Since then, while many other tech names have rebounded like crazy, Snowflake's only traded back up to 163 as of today's close. But tonight, these guys reported a tremendous quarter. Snowflake beat expectations on every key line item for the quarter: revenue, product revenue, operating income, free cash flow, you name it. At the same time, management gave us strong product revenue guidance for the current quarter and raised their full-year product revenue forecast. They gave you a little less, lower margin number, but we'll find out about that. So with the stock coming into the quarter cold, these numbers were enough to send it higher in after hours. Is this the beginning? Let's check in with Sridhar Ramaswamy. He is the new CEO of Snowflake. We interviewed him once before. We're out of GTC. Find out more about the quarter, where it's going. Mr. Ramaswamy, welcome back to Mad Money.
Great to be chatting with you, Jim.
Okay, so Sridhar, this was a very impressive set of numbers. The one that really stood out was this 46% growth in what's known as remaining performance obligation. I regard that as the key indicator of the future. What's driving it?
Jim, I think overall, there are two broad strokes to the quarter. One is that our financial performance was really, really good. Our product revenue was up 34%. Remaining performance obligations, as you talked about, was up 46%. Some very huge deals. It's really an indication of how much our customers believe in us. Our free cash flow margins were also amazing. The other part of Q1 is really how our product pipeline, especially in AI, has been in overdrive. Our AI products are now generally available. Over 750 customers are developing on it, sending applications to production. And I would say the era of enterprise AI is here, right here at Snowflake.
Well, let's talk about enterprise AI, because you gave a number of use cases and some customers everybody knows. I'm going to pick one. People know it because it's on their dining room table. Kraft Heinz. Why does Kraft Heinz need Snowflake?
Can you repeat the question, Jim?
Why does Kraft Heinz need Snowflake?
Kraft Heinz is an iconic brand, but they have lots and lots of data. And so part of the magic that Snowflake brings to the table with its AI offerings is that you can analyze customer feedback data very easily using language models and figure out which questions, for example, have automated responses that you can send, which ones you should send to like an actual human. These are the kinds of applications that people are thinking and implementing with Snowflake. And the beauty is we make it real easy out of the box and super efficient to get these done.
Now, you also made an acquisition. Some people said to me, you know what, I can use Snowflake, but I have to then observe. I have to interrogate my own data. I don't know. I mean, I rent these guys. I have to bring it back. Tell me about what it will mean that you have true era AI observability now that you've bought this new company that I think is going to make it so that you guys are. I don't know how much you need Amazon Web Services once you do that. I don't know. You tell me.
Well, one small clarification. We signed a definitive agreement to acquire them. The actual acquisition we expect to happen soon.
Fair enough.
But as people are racing to develop AI applications, things like observability becomes important because let's say you change the prompt. You still want to make sure that the application's working well, or you want to try out a new model. It's all part of our mission to make AI reliable. And change management, which observability closely ties into, is an important part of making AI reliable. That's why we acquired this great team. But the general theme, again, is we make end-to-end AI easy to implement, easy to maintain, dramatically lower total cost of ownership. You don't have to run GPUs if you want to use AI with Snowflake. That's the stuff our customers love.
All right, but let's talk about GPU because you've got your June 3rd through 6th Data Cloud Summit. I remember watching a video of Jensen Huang with your predecessor, Mr. Slubin. Mr. Slubin was famously tough on price when it came to Jensen. What will the powwow be like this time?
Well, I've gotten to know Jensen really well over the past few months. We are super excited by the promise of accelerated computing. Language models are just the beginning. I think it's a powerful way to scale things. We collaborated with NVIDIA on a number of fronts. Our foundation model, Arctic, was unsurprisingly done on top of NVIDIA chips. We collaborate with them on models. There's a lot to come, and Jensen's, of course, a visionary when it comes to AI. We're going to be talking about all of this and many other new product announcents at our user conference as well. It's going to be exciting, and I'm looking forward to seeing you there.
Oh, well, let's see what we can do. I do want to ask you about the margins. Your revenue's going up very well. The margin's a bit of a decline. Something I should be worried about? You know how much we care about margins in this business.
Yeah, margins are really, really important. Of course, I work with Mike, who is amazing at this. We are leaning ahead into investing with AI. Now, these are modest size investments, and I don't expect these numbers to dramatically go up. And what Arctic clearly showed is that you can get a lot done with a small motivated team and a small amount of compute. Arctic was done on $2 million of GPU compute. And of course, the products are out in GA, and we are driving it. We are taking it to market. We want customers to use it for us to make dollars. I think we are very much in the mode of driving revenue for our AI products, and definitely hope to share more of that in the coming quarters.
Got it. Now, Mike, your CFO, did mention at one point that growth moderated in April, but he said that was a normal component of the way that things are in your business. Why is that?
Well, the Snowflake is a consumption model, which means that we make money only when our customers consume. Now, when there are holidays, for example, people don't run certain kinds of jobs, as you know, like Easter is usually in April. So there are seasonal variations like that. But the overall trend that we are seeing in the business, the conversations, the vibe that I have with the customers that I talk to is hugely positive. People are truly excited by Snowflake as their data platform for data, for collaboration, and now AI applications. And you have customer after customer take multi-year contracts with Snowflake. It points to a bright future where the code is strong and we are pressing the gas really hard on new things like AI.
All right, so do you still speak to Mr. Slubin? I only mention because he's one of the few friends of the show where I just respect him greatly. So how's the communication?
It's actually, he is incredibly kind. I talk to him every other week. We also chit-chat on WhatsApp pretty often. Obviously, he's the chairman of the board, and spent 10 quality hours with him yesterday. I kind of tap into his wisdom for how to create a great business. And he's going to stay, my friend and Snowflake's friend for the foreseeable future, and very much a part of Snowflake.
Will you tell him we said hi and congratulations on a great quarter? That's Sridhar Ramaswamy, Snowflake CEO. Thank you, sir. Great to see you.
Great to see you. Thank you, Jim.
Everybody's back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It's time for the lightning round. Because remember, that's where it calls right fire. You saying the stock? I said buy, sells and sell. Jump, calls right at a time. My step is going to the buy. Are you playing this now? And then the lightning round is over. Are you ready, Ski? Time for the lightning round. I want to start with Dave in Missouri. Dave.
Booyah, Jim.
Booyah, Dave.
Whole family are club members, so I wanted to let you know that.
I love that. Thank you. It's like password sharing. I'm okay with it for a bar play. I'm no Netflix. I'm no Netflix.
Right. Hey, calling about a stock that was in the club bullpen, Next Tracker.
Oh,
right?
It's killing me. Listen to me, Dave, it's killing me. I was talking to Jeff Marks. I said, can you believe that Shug, this is the CEO of Next Tracker, that thing got game today. It's like a First Solar come on, you know? Well, we're going to have to address that when we, it's went up a lot. But I'm still a believer in Shug even at these levels. Tom in New York. Tom.
Good evening, Jim.
Evening.
Jim, my question is on a company that I'm sure has been around longer than you and I combined. I would appreciate your thoughts on how this old company might fare in this new AI data center onslaught. The company is Corning Incorporated.
You know, look, I've loved Corning. I used to coal in that area up there with the horse heads, and that's the name of the town. But I've got to tell you, it's Corning, New York. I've got to tell you that this company has failed to, ever since the 1999-2000 when it over-earned, it has not been able to generate the kind of return that I've wanted. I would not be a buyer all the way up here. I just can't come up with a thesis. I need to go to Mike in Illinois. Mike, my bike.
Jim, how are you? Long-time listener, many-time caller, and club member.
Yes.
Axon, I own some of it. I've owned it for a while. I bought more when it went up. It's messed up my basis. Now it's come back down. It's kind of in the middle, right where my basis is at. Should I buy more, get rid of it?
I don't know. I thought Rick Smith did a great job. I think that the quarter was really good. I think the stock sold off because it's been just an incredible juggernaut. I would hold off right now. I think you could probably buy that stock at $250 if it gets there. People hate the chart or whatever, but then you'll be at the right level. The stock does have a high price earnings multiple, so I'm a little more skittish than I would be otherwise. Dan in North Carolina. Dan.
Hey, Jim. Booyah!
Whoa,
from
holy.
North Carolina.
There's a guy who needs to keep his day job. What's happening?
Hey, trying to get to your take on Recursion Pharmaceutical, RXRX.
Okay, after we had them on 2 Fridays ago, I thought for sure their announcement on Monday was excellent, would move the stock. What's going to move the stock is they do have an investment, and it's a serious investment by NVIDIA in them, and I think, therefore, it's a terrific spec, and I would buy it. Let's go to Alex in Florida. Alex.
Hey, Jim, how's it going, man? I was just, thanks for having me again. I was just wondering what you were thinking about Intuitive Machines with the recent successes, such as U.S. moon landing.
You know what? I'm not there. I'm not there on that. I've got too many stocks I like that are doing really terrific things that I've got to go down. I mean, it had a one-day wonder. It had a big spike, and I feel like I missed a spike. I don't want to come in on top of that spike. Let's say not for me. Okay, now we're going to go to Tori in Louisiana. Tori.
Hey, booyah, Cramer.
Booyah, Tori. What's happening?
Thanks for taking my call.
Of course.
So what's your take on Kratos as a
I have liked that. Look, first of all, I like defense contractors. There are very few small ones. And I don't know to buy them anymore, probably because of antitrust. That is one we've liked since 11. I think you stay along it, maybe even buy more. Ron in Utah. Ron.
Hey, hi, Jim. Thank you for all the help you give us. Little fish swimming upstream against those big sharks. I want to shout out to my fellow flying Navy pilot, Bill Stewart, the local company I've got, Merit Medical, MMSI. What do you think?
I think it's good. I mean, a little bit pricey, but real good growth rate. This is the kind of company that one day you wake up and it's bought by somebody else. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, why this big box battle is just target practice for Walmart. Next.
After today, it's no longer fair to compare Target to Walmart. At best, you could say they're like apples and oranges, two retailers with less and less in common, to the point where the whole comparison, it's meaningless. For years, we got used to Target beating the pants off of Walmart when it came to head-to-head comparisons. Target always gave us better same-store sales growth and more exciting stories of consumer enthusiasm. Now, though, you know what? The shoe is actually on the other foot. Walmart's crushing it with much better than expected store numbers, while Target's putting up largely inline results, which is not enough to do the job and not what I'm used to from Target. And that's the main reason why Target stock was down badly on earnings, while Walmart stock just keeps hitting new all-time highs. But let's go back to the notion that the whole comparison is just meaningless. With this quarter, we're seeing something I never thought I'd see. Walmart's producing value while giving you a level of unparalleled convenience and even a sense, God trust me here, of chic. Yeah, chic at a price. There are many things I couldn't imagine saying about Walmart, but a sense of style and a style at a reasonable price, that was never one of them. I know it's hard to believe unless you've been to a Walmart store lately, and I advise you to do so, but they have apparel lines that are ridiculously cheap and are whimsical, surprising, and just plain old cool for the millennials and the Gen Zs of the world. You think Walmart's mostly canned and frozen with lots and lots of junk food piled high in the aisles, Little Debbie? Just the opposite. They have a display of fresh, organically grown food right up front that puts them on equal footing with Whole Foods on quality and well below in price. Then they have whole new lines like the just announced Better Goods. That's the largest private brand. Get this, 70% of the items are priced below $5. Take that, dollar stores. They have the incredible value of Walmart Plus, which many feel rivals Amazon Prime for deals. They keep surprising you with great offers, like today's announcement of a deal with PAW for telehealth pet care. Hey, a lot of their customers have pets. Finally, from the point of view from the shareholder, Walmarts.com has a burgeoning advertiser business. That's like Amazon's, that big Amazon business that's just pure gravy. And Target can't do that. In fact, it increasingly feels like Walmart and Target are not quite in the same business, which is the problem for Target. Don't get me wrong, Target's a terrific company. It didn't miss its numbers. It's fun to shop at. But in the end, it's become a meaningful domestic enterprise, while Walmart's become an international colossus. I actually think Target's setting itself up for a good second half, and its stock might be a buy after it settles down. Strangely, though, it only just decided to cut prices on 5,000 items. After initially only cutting 1,500 this year, we need inflation fighters at the helm. Walmart's taking everything down. They know the best way to get you in the store is to fight inflation. They're all rolling back prices aisle by aisle, and the customers are craving it. In the end, I don't think I can compare the two. They're just two different animals. So who is in the class with Walmart? Only two companies, Costco and Amazon. In fact, it's just a three-horse race now. All three are global titans. All three offer great value, with Costco coming in the cheapest, given its concentration of about 3,000 different products and a club card business, while the others have much broader assemblage, very good prices. All three have scale and heft that nobody can match, something, by the way, that Kroger understands, which is why it's trying to merge with Albertsons in order to compete with them. I think Kroger, like Target, runs the risk of being left behind. Not irrelevant, but left behind without that deal. But the FTC wants to block it because the last time Albertsons merged with another supermarket, they made a mockery of the whole regulatory process. I don't blame them. When Walmart was dowdy and cluttered with no sense of order, I could never say that they did retail supremacy, and I'd scoff at those who did. But this is a new, well-organized, well-run, well-managed Walmart that's succeeding on price and value and convenience and even, yes, style. Target still has work to do. I bet it'll get there. At the end of the day, though, Target's worried about the state of the American consumer. But Walmart? I don't think Walmart's worried about anything. I like to say there's always a bull market somewhere. Promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.